Hello, is anyone on the call yet?
Hey, Trace, I'm on.
Hey, hi. Is Elliot on yet?
Yep, I'm here.
Oh, hi, Elliot. It's Tracy. How are you?
Well, I'm doing great, Tracy. How are you doing? Happy holidays.
Same to you. I'm going to give everybody a few minutes here to get on the call, and then I will introduce you, and then you can take it away.
You know what? That sounds perfect. Thank you so much.
Thanks. Okay, I'm going to get started here. I want to thank Elliot for helping us out with this ETF series that we've done. Elliot, actually, you were in Hershey and spoke, correct, Elliot?
Yeah, I was actually.
Awesome. Okay. So Elliot has over 10 years of experience in the ETF industry, ranging from ETF sales and product management at BlackRock and Charles Schwab Company to ETF evaluation and selection in client portfolios as a registered investment advisor at an RIA firm. He also has significant experience educating investors on ETFs and the nuances of product structure, due diligence, and selection. Elliot's expertise in the ETF industry has provided him with deep insight into the evolving investment needs of a broad range of clients that include fund analysts, advisors, and retail investors. And I'm going to let Elliot take it away. Thank you.
Thank you. It sounds like they gave you the extended version of my bio. Thanks a lot, and happy holidays to everybody. Yeah, exactly. So good morning, good afternoon, depending where you are in the U.S. And I'm out here in San Francisco, so it's still 10 o'clock my time. But happy holidays to everyone. Happy to be here today. It's my understanding that at least several of you may have already sat through the first webinar, which was my colleague DJ Tierney, going over some of the kind of just overarching ETF landscape information, how many providers are out there, what are the assets in the industry. And then I believe he probably had a little bit of time to start talking about tax efficiency with exchange-traded funds and why the products are a little bit unique. What I did want to do was, just before we get into the more advanced component of our education series today, I did want to share just a little bit of information and data that I think is kind of relevant at the moment in this industry, where we're at with the growth of ETFs. And I thought it's kind of a nice way to tee up our conversation today. And so I wanted to just, again, highlight where we're at. Obviously, there's over 2,000 exchange-traded funds on the market at this point. But what we're seeing here is a really interesting trend. Since I started my days in the ETF industry, actually about 12 years ago now with iShares, you know, we used to just watch that there were always new ETFs coming to market, new launches, and that was really all there ever was. There were only just a few product closures in the market. Well, what's happened is now we're seeing a really kind of fast expansion of the amount of closures. And there are a lot of things, I think, that are leading to this new trend. But one of the biggest ones is that there are more and more products out there referred to as strategic beta, so products that don't track a market cap weighted index. And many of these products have been developed based off of some historical data, back-tested returns, and many of these products just aren't trading very often. Not a lot of clients are interested in using them. They don't maybe understand how to use them. And so we're seeing a lot more closures. And so this year, you can see here, when I cut this date at the end of September, we were already up to 84 closures. By now, we actually are approaching 100 ETFs closed in the market this year. The majority of those kind of fall into the multi-factor or the strategic beta part of the world. But in any event, it's an interesting trend that we're continuing to watch. If any of you use the website ETF.com, which is a free service where you can go in and search for exchange-traded funds by their sector coverage or regional coverage or asset class, you can also put in a specific ticker and do research on that particular fund. That service actually has a closure rating assigned to many products. And so as you look through the vast landscape of products that are out there, there are some tools to help you figure out whether or not a product is trading very much, whether it's gained any assets, and whether there is a risk of closure in the near future. But anyways, just an interesting trend that a lot of advisors are now aware of. We have actually eclipsed the $4 trillion mark in the industry, which I think is a fantastic watermark for us. But keep in mind, the reason I like to point out that data point is, in comparison, exchange-traded funds sitting at north of $4 trillion, the mutual fund industry still has somewhere in the ballpark of, call it 30 to 35 trillion, depending on whose data you look at. So still the lion's share of the industry's assets are in mutual funds, and in the mutual fund structure, obviously we've seen some growth recently with exchange-traded funds. I also thought it might be kind of interesting to show you where some of the flows are going. And this data is from last year, but the data from this year looks very similar. So trend we're seeing here is that obviously a lot of money is flowing into ultra low cost exchange traded funds. You'll see here that 60% of the flows last year, and it's around the same number this year, went into products that had management fees of 9 basis points or less. So a real interest here in ultra low cost, index-based, tax-efficient exposures for your clients. You'll see here that 35% of flows last year went into products between 10 and 20 bips, and 95% of all industry flows went into products with less than 20 basis points in management fees. So again, a real push here for ultra low cost products at the core of clients' portfolios to help them keep more of their returns over the long term. And then Schwab, as a broker-dealer, obviously we represent the asset manager, but as a broker-dealer, Schwab puts out an ETF use study every year. We actually are the largest ETF custodian in the United States. And I thought this would be kind of interesting to show you guys real quick. So ETF use is tilted in the direction right now of younger generations that are more tech savvy. You got millennials and then Gen X, and I belong to the Gen X generation. I'm 45. So millennials and Gen X are tending to use ETFs and portfolios much more often than older generations. The reason some of this data is interesting, and by the way, you'll see here that the question on the survey was, what's the mean percentage of your portfolio in an ETF? Millennials answered 42% of their portfolios in ETFs, Gen X 34%, Boomers and 24%. But as I kind of quickly show you some of this data from the survey, the reason you want to think about this is that obviously we still have a number out there that we believe is going to transfer from Boomers and even older generations down to Gen Xers and Millennials. That wealth transfer is somewhere in the ballpark of 30 trillion. The number that I've seen recently is somewhere around 25 to 30 trillion will be transferred as folks pass away to younger generations. And these generations have already started to adopt exchange-traded funds within their portfolios. If you read Forbes' article about 2 months ago, they do now actually know that the baby boomers are spending an alarming rate, and so they may spend down some of that wealth transfer that's predicted. So maybe we're looking more at 20 trillion instead of 30. But as that trend starts to really accelerate, the folks that will be inheriting these assets will be using ETFs much more readily in their portfolios. So the question here was, ETFs are expected to be a primary investment in my portfolio in the future. Obviously, 80% of millennials said yes. 60% of Gen Xers, or 59%, and 37% from Boomers. So anyways, a trend that we have been watching now for probably the last 5 or 6 years as this study comes out each year, that younger generations continue to use ETFs. And again, with this wealth transfer, this is going to be a rather important topic. So I'll stop there. I just thought it might be fun to share a little bit of kind of overarching, backdrop here, things we're talking about in the ETF industry and who's going to be using these products going forward and some of these important trends. So I will close out of this presentation, and then I'll open up the advanced concepts. So again, DJ Tierney, my colleague, a couple weeks ago provided just an overview to the ETF landscape, talked about the amount of assets in the industry, talked a little bit about who the providers are, and then got into a little bit about tax efficiency. What I'll try to do for you guys today is just provide a short reminder of some of the things that DJ talked about around tax efficiency, and then we will move into this more kind of advanced content. And I do want to leave plenty of time for Q&A today. I know we have an hour scheduled. I don't plan on using up that entire hour. So we'll get through everything at a high level, and then anything that you guys would like to drill down on and ask any questions, I'm here to answer them and happy to do so. So the key takeaways from this, what we refer to typically as our advanced concepts presentation, is that we will kind of review again how ETF liquidity is unique. Well, it's a little bit different than trading stocks. We will talk a little bit about the differences between the primary ETF market and the secondary ETF market, what those are and why they're important to you and your clients. And then we will wrap up with just a short discussion on securities lending and exchange-traded funds. And these are some of the topics that I actually covered in Hershey when I was out there, but today we have a little bit more time. And if anyone would like to dig a little bit deeper as we go through this, we can. So why don't we start out just talking a little bit about ETF liquidity and why this is important. So in the presentation that DJ provided a couple weeks ago, he talked a little bit about the fact that exchange-traded funds are a bit different than trading stocks and a bit different than investing in a mutual fund. And so if you think about trading stocks, obviously stocks have typically a finite amount of shares that are available in the market. And so if you picture in your mind going to, the NYSE and putting in an order to purchase 5 times the average daily volume of a thinly traded small cap US stock, just as an example, right? One of the stocks that's in the Russell 2000 index. If you went in and actually wanted to trade 5 times the daily volume of that stock, obviously that trade would take a while to fill. It would be filled in probably small chunks by a market maker, and the bid-ask spread on that trade would be rather wide, right? Someone would be charging you, and you would be paying for them to help you source all those shares of that stock that you need. And again, that wouldn't get filled immediately. It would take some time, and there would definitely be some impact to the market value of the stock when you place that trade. With an ETF, it's different. ETFs actually have both daily volume and liquidity that's traded on the secondary market, which you see off to the right side here. But there's also the ability within what we call the primary market for new shares to be created. So if you think about my example with the Russell 2000 stock, if you were able to approach that company and say, I want to trade 5 times the average daily volume of your stock, I need you to create new shares of that stock for me to trade today, that's in essence what's happening with the ETF. So if you wanted to trade 5 times the daily volume of a Schwab ETF today, most of that first, batch of shares would come from the secondary market where buyers and sellers are trading the Schwab ETF. But then the remainder would come from an authorized participant, so a professional market maker approaching Schwab and saying, I need 4 more times your daily volume of your ETF today created so that I can actually fill this trade on the market. So they would come to us, create shares. When they create those shares, they're delivering to us the underlying securities that are in the fund, and we give them the shares of the ETF back, right? So it's a tax-free exchange where, again, they're bringing the securities to us that are in the fund. They give us those securities. We give them the ETF shares, and they go out and fill your trade for you on the NYSE. So this is a big difference between trading stocks and trading exchange-traded funds. So you see here on this screen, we've just got most of the kind of important players in this process, right? I already mentioned authorized participants who are there at the top. The authorized participants are the folks who come to Schwab and sign an agreement with us to be able to create new shares of our ETFs as needed to fill trades on the secondary market. And then you'll see there at the bottom, it mentions that we have a capital markets team. So all exchange-traded fund providers have a team of folks who are closely watching the trading of their exchange-traded funds on the NYSE or any other trading venue throughout the day to make sure that they are trading efficiently, that bid-ask spreads are nice and tight on those trades, and that the liquidity or the necessary liquidity for investors is there and available. So think of them kind of as like the police force for an ETF product lineup. So this is the new kind of unique structure that DJ introduced to you folks last time around. And it's what we'll talk a little bit more about today. And I have some actual examples that hopefully will really help you think this through a bit. So this is a chart that you will find in most marketing documents that you would get from an exchange-traded fund provider. Folks are always trying to just come up with a nice, easy way to represent this process. And so you'll see here on the right side, the primary market that we just discussed, where the market maker is approaching Schwab and saying, we would like to either create new shares of your fund or give you back, redeem shares. And you'll see the yellow arrows here show you the ETF shares moving in or out of the fund. And then obviously the blue arrows, the light blue arrows show you the direction of the securities moving, obviously in the opposite direction of the ETF shares. And then on the left side, you're very familiar with trading stocks, so the secondary market is going to be familiar to you. You have buyers, sellers who are typically transacting through a broker-dealer who then routes trades to the appropriate exchange. But what we're going to talk about now is give you a couple examples of why this can really lead to some strong tax efficiency in the exchange-traded fund structure. So here is an example of an index rebalance. So if you think about with index funds, right, no matter whether it's a mutual fund or an ETF, with an index product, turnover should be a lot lower, right? Typically, indexes only have turnover when the index itself changes what holdings are included in the list of stocks or bonds. This is usually done either once a year or quarterly, depending on the index and how it's structured. But that's really when you're going to see major changes to a particular fund. So within this example, you have an ETF that's US large cap, and there's some stocks that have shrunk in size within the US large cap space, and they actually have now moved from the large cap index down to mid cap, because again, they got smaller. So as the ETF portfolio manager takes a look at the index and decides, okay, what should my fund look like going forward to best track this index, they're also going to have to get rid of those stocks. When the stocks leave the index, the fund needs to get rid of them. But here's the big difference. In this example, this is very different than what happens in a mutual fund. In the mutual fund, the portfolio manager would have no choice but to sell the stocks that have left the index to get them out of their fund. In this example, we're actually using the exchange traded fund structure that we talked about 2 weeks ago with DJ, and now that I just mentioned earlier, where you can actually simply move the deleted stocks that have left the index out of the fund, and you see it there with the yellow arrow. Those stocks are being moved out of the fund without being traded inside the ETF, as ETF shares are redeemed back into the product. So again, a reduction in the amount of trading that's going on inside of the ETF that leads to a much better tax efficiency experience for the investors. So the ability to limit or reduce the amount of capital gains that come out of the ETF based off of turnover in the fund. I have a couple other examples and benefits for investors as well. Here's a large trade on the secondary market, and as I mentioned a few minutes ago, this is a nice example of how somebody who's trading a multiple of the daily volume of the fund gets this trade taken care of through market makers. So here was a large endowment, and this happened about 12 or 13 months ago in one of our ETFs. We had a large endowment who wanted to buy, it's about 125 million of our SCHF, which is our Schwab ex-US International Equity ETF. SCHF doesn't trade as much as what this endowment wanted to purchase. So when they looked at buying 3 times the ADV of the fund, they actually had to work directly with a professional authorized participant to get the shares that they needed. And so you'll see here how this worked. First, on the left side, the endowment got some of their shares through the market maker going to the exchange, to the NYSE, and just simply getting the SCHF shares from another seller. But there were still some shares left over that they needed. And so they went to the right side of the screen, and they came directly to Schwab and created the shares that they needed to fill that gap. So they went ahead and created new ETF shares. You'll see the ETF shares coming to the market maker in the blue arrow there. They delivered in all the stocks that belong in SCHF, the International Large Cap product, and they turned around and then were able to fill that entire trade for that endowment. The benefit here is that there was minimal to no impact on the price of SCHF when this large institution was placing the trade. There is this misnomer in the market that when large institutions are buying in and out or trading in and out of an exchange traded fund, and you are a long-term investor or buy and hold investor in the fund, that you're getting impacted. You can see here that actually there really wouldn't have been an impact. If you had a client who was trying to trade that day in SCHF, either buy shares or sell shares, they would not have even known from just the price movement in the security. They would not have even known that this large endowment had bought 3 times the daily volume of the fund. Whereas with my Russell 2000 stock example I gave earlier, the price of that stock would have been impacted when someone placed a trade of that magnitude. But within this ETF, since there's extra liquidity available through the primary market, you could just take a look at the trading price throughout that day, and you probably would not have known that this massive, massive trade had happened in the fund. And so again, if one of your investors was buying or selling that day, they would not have been impacted by this large institutional flow. And then finally, this is an example that we go through from time to time, just as a reminder that the process of creating shares or redeeming shares in ETF is a profitable process. This is something that market makers or authorized participants are able to do intraday to make money. The reason this is a good thing for investors in the funds is that when they see the ability to arbitrage or profit from the difference in price between the ETF shares on the secondary market at the NYSE and what the underlying stocks are worth in the actual fund, when there's a difference between the fund's net asset value and its market price, there's an opportunity for market makers to make money, to arbitrage that difference. The minute they place that trade, the market price of the ETF comes back in line with its intraday net asset value. So this is the mechanism when somebody asks, oh, you know, how often or why would an ETF's market price deviate from its net asset value? This is the intraday process that's in place to try to help keep market price in line with the estimated intraday value of all the stocks or bonds in the fund. So when we get into secondary market trading, I realize that there are some advisors who don't do a whole lot of trading for themselves. And so we usually quickly just go over the direction the industry is headed when it comes to trading on the secondary market. But there are a few things here that are a bit familiar to you and your clients, which is fantastic. Obviously, if your clients already invest in mutual funds, they are familiar with what a trading commission is, and they're probably familiar with expense ratios, the fact that the fund manager is charging an annual fee that comes out of their daily performance to pay for the portfolio managers, the research, marketing of the fund, all those things. So operating expense ratios and commissions on the left side of the ledger here are going to be a familiar component to mutual fund investing. And on the right side, the good news is anybody that's been trading stocks is going to be familiar with the implicit costs of what a market impact could be or bid-ask spread on a stock trade. Again, market impact being if I try to go trade 3 times the daily volume of a thinly traded stock, I'm going to move the price of that stock by the time I'm done trading. It's just a part of market forces and how it works. Obviously, with exchange-traded funds, we have the primary and secondary market working together to try to minimize market impact, as we talked about a few minutes ago. I don't really want to go very deeply into bid-ask spread, with the exception of realizing that exchange-traded funds, since it's a basket of hundreds or thousands of stocks, there are a lot of other inputs that go into why a bid-ask spread might be narrow or a little bit wider on a particular product. If you're ever researching an ETF and you see that it has a wider bid-ask spread of, say, 4 cents, 5 cents, upwards of 10 cents wide, you would want to reach out directly to your wholesaler or that product provider to get a little bit more information as to why it's trading at a wider spread. What you should expect, most of the largest and most liquid ETFs in the market trade at the most narrow spread possible, which is 1 cent, right? You can't go any less than 1 cent wide on the difference between what a market maker would pay to purchase or sell the shares on the secondary NYSE. So here are some of the underlying things that go into a bid-ask spread in the ETF. We don't need to go too far into this. Just note that in the end, ETF bid-ask spreads have some other inputs that are a little bit different than just, hey, what's the daily volume of this stock? And how big is the trade that you're placing, and how risky are the assets inside of this portfolio here within this ETF example. But as a rule of thumb, typically the more liquidity or the more volume that's traded for the ETF, generally the bid-ask spread should be tighter, as I mentioned, 1 cent being the tightest it can possibly be. Now, some folks will look at bid-ask spread and try to figure out what it is in terms of a percentage of the total cost of the ETF. So instead of looking at it in dollars and saying, oh, it's 1 cent wide, you would take the 1 cent bid-ask spread and divide it back into the actual net asset value price of the ETF, and then that would tell you what the bid-ask spread percentage is. So you know, okay, if I trade this ETF today, my client is going to be hit with, you know, whatever X percentage is on this particular trade in terms of bid-ask spread. The industry, in terms of trading on the secondary market, has started to really encourage people that do trade ETFs on a regular basis to tilt their trading behavior towards limit orders. Now, there are a couple different types of limit orders out there available. Many of you are probably familiar with them, but if you go and put in a traditional limit order, obviously you're trying to take control over the price of the trade, but you don't have as much control over the timing of the trade. So until a price is available that's within that limit order that you've set, you won't get execution on your trade. That's why some folks are starting to tilt towards marketable limit orders, which is, okay, instead of keeping my limit order right somewhere around where the bid-ask spread is, I'll put my trade request in, I'll put my limit order in, maybe a cent or 2 cents outside the bid-ask spread, just a little bit wider, to try to make sure that I'm getting a good, rapid, quick fill on my trade request. So again, many of you probably aren't doing a whole lot of active trading in ETFs these days, but many institutions that trade larger amounts of ETF shares are assigning limit orders or marketable limit orders to their large trades, and we're seeing more and more advisors do the same to try to take a little bit more control over price in terms of trade execution. So a definite trend that we've seen over the last, say, 5 years or so. And then when you think about trading ETFs, there's some factors to also think about in terms of timing of the trade, the order size, and then the intraday indicative value. The good news here is that with actually the release of the new ETF rule in the market, the far right is not as important anymore. So intraday indicative value is going to be less and less of importance as more and more data information is being required of ETF providers on their website, and making sure that as folks trade ETFs, they have the best information available to them at all times. So intraday indicative value, although it's still a data point that's out there and available, it tells you what is the estimated value of the ETF's net asset value currently, right now, during trading. And you compare that to the market price to figure out whether the ETF is trading at a premium or a discount. But again, there's going to be a lot better and a lot more data available intraday trading now after the release of the new ETF rule that was approved by the SEC recently. But on the left side here, under trade timing, well, a couple things to keep in mind, right? Try to avoid trading around things like, dividend distributions. Or if you are going to trade around a dividend distribution, be aware that you are trading either before or after the fund having a substantial adjustment made to its net asset value. The minute the dividend pays, obviously the net asset value of the fund drops a bit. Also around timing, if you're trading international ETFs that own and hold stocks that trade in other time zones, if ever possible, try to trade your ETF shares on the NYSE during times when time zones are overlapping. So an example would be an MSCI EFA product that invests in international large cap stocks. Those markets tend to start closing by the time we get to late morning in the NYSE and New York market hours. So try to time your trade so that you're trading while some of those MSCI EFA markets are open, because once they close, after hours trading here in the US could really move the market price of the ETF away from their closing values in other time zones overseas. And then finally, always consider order size. So how big is my trade? What's the average daily volume of that ETF? And am I going to have some sort of impact where when I go and place that larger trade in that fund, is a market maker going to have to go create new shares? Do I need to work with someone directly to get that filled, or am I only purchasing a few thousand shares and a real small component or portion of the daily volume? So all interesting things to consider, but a lot of these concepts or content is really focused on those folks that are doing a lot of active trading in ETFs. And again, I understand and realize that many of you probably aren't doing a lot of active intraday trading. Many of your clients are probably simply buy and hold. But here's the final, and what I think is an important topic, one that is getting more and more coverage in the media these days. So Securities lending is the process that asset managers who either run mutual funds or run ETFs do to try to help boost their performance in the fund. If it's an index product, if you're lending securities out of that fund to get income back into the fund, you're trying to just track your benchmark more closely. If you're an active manager, you might be lending securities out of your fund to get regular revenue back into the fund to actually try to help outperform the index. So it depends on whether you're an active manager or an index manager. Obviously, in the ETF space, majority of the assets, as DJ showed you a couple weeks ago, are in index products. So in the index space, securities, either stocks or bonds, are lent out of the exchange-traded fund or mutual fund to institutions that would like to borrow those securities, typically to short them. But that when that loan happens, there's an agreement where there will be interest charged to the borrower, and that interest goes back into the fund's performance to help the fund more closely track its benchmark. Now, there are some differences in how ETF providers approach securities lending, and this is important to know. There are some providers who keep revenue from their program as revenue to the firm. So not all of the earnings from the securities lending goes back into the fund's performance. They'll do a split where some of the fund's performance will get a boost, but they will also keep some of the revenue. At Schwab, our approach is we do not keep any securities lending revenue in our funds as revenue to the firm. Once we pay our lending agent to do the securities lending for us, once we pay them their fees, the remainder, about 90% of the revenue, the remainder of that goes back into our fund's performance. So again, we do not keep at Schwab within our ETF lineup any of the revenue, but there are differences in how folks approach this. Also keep in mind, when someone comes to borrow securities from this exchange-traded fund or mutual fund in this example, they do have to post cash collateral, right? They are borrowing securities. They need to put up cash in the value of those securities, and it is marked to market on a daily basis, meaning if the stock or bond gains or loses value during the day, at the end of the day, that borrower has to put up more money to make sure that they're covering whatever collateral amount is required on that borrow. Some folks borrow securities for very short periods of time, and some borrowers actually hold on to the securities for a little bit longer. So it just depends on who the institution is and how they want to go about their trading strategies. But the reason this is more and more important in the market, and I will open up things to questions here in just about 2 minutes or so. In the end here, the reason this has become important for you guys to understand is that the media is starting to write about this, and you may have some educated investors or clients who really read the Wall Street Journal on a regular basis, or maybe they're reading online, maybe they're going to Seeking Alpha or wherever else they like to stay up to date on financial markets. This is something that's getting written about now. Many investors are aware that securities lending is happening. They're aware that this is a process that is heavily regulated. When you look at a securities lending program, obviously there is some risk involved. So all of the asset managers that do this have a real, intense focus on risk and return. And you may get questions at times. And so for you to be able to say, yes, I'm aware that securities lending is happening in some of the products that you're invested in. This is how it's done. This is how the programs are structured. And then the final important takeaway for you here is, if you ever have a question about how securities lending is being done by a particular asset manager that you partner with, just reach out directly to their wholesaler or reach out directly to their 800 line, and they should be able to provide you with information about their own program and how it's run. So obviously, I'm only really qualified to talk about Schwab's program and how we do it. But if you have questions about anybody else that you're using, either for ETFs or mutual funds, you can always reach out to them directly, and they're always happy to answer questions and get you up to speed on how they're running their program. So I'll stop there. We've covered a whole lot of kind of 201 in-depth content, and I wanted to make sure to leave plenty of time for questions and answers. It's only 40 minutes after the hour, so we have about 20 minutes if you guys have questions. So I will pause and let you guys open up the lines. while I'm waiting to
Does
see if there are
anyone have any
questions, I'm
questions?
pull up this dashboard here just so I can see if anybody types anything.
We have a quiet group today, Elliot.
That's okay. Well, hey, you know what? It's the holidays, and I think everybody's probably getting ready to wrap up their year. I will just say I realize this particular module, the more advanced module, is one that I think it's always best to try to skim mountaintops and stay at the highest level possible, and then wait and see if there are any kind of deeper questions around the content. Should anybody have something they'd like to send as a follow-up, feel free to send questions to Mindy Folger directly, who's your regional specialist here at Schwab. Many of you probably have had a chance to either work with her in person or talk to her on the phone, but don't be shy. I know some of these concepts, when I go out and present this in person to larger groups, there usually are some, you can usually look out in the audience and see the look on people's face. There's sometimes a little bit of confusion, and I know some of this stuff gets a little bit more in the weeds. So if you do have follow-up questions, please reach out direct to Mindy, and I'm happy to either jump back on a call with you and or respond via email. But I thank you all for your time today, and we obviously thank you for your continued interest and use of Schwab ETF products. And I just wish everybody a happy holidays and obviously a safe and happy New Year.
Thank you, Elliot.
Thank you. Take care.